All right, it's no secret that a lot of small investors, retail investors have discovered the excitement of the stock markets and looked at it as an option of investing and making some money after the pandemic hit in 2020. And that love affair has continued and it's going strong. The latest data is showing that stock investors are pumping their money and bringing their holdings in listed companies to a record high in June. In fact, retail investors increased their exposure to NSE listed companies to an all-time high of 7% in June from about 6.74% earlier. We're seeing money come back into mutual funds as well. And one of the things that is possibly exciting small investors, among other factors, is the whole flush of IPOs. There are 50 companies with IPOs in the works. Several have listed in the last 7 months and many more are waiting in the wings. So what does this heady cocktail all mean? What is it leading to? Has the depth of the Indian markets finally really increased as was being hoped for several decades? Are these investors here to stay? And what needs to be done to ensure that they don't get burnt? Speaking on all of these aspects today is Pranav Haldia, MD of Prime Database. Hemang Jani joining us on the show, Senior Group VP of MOFSL. Ajay Bagga, market expert, with us today, as is Sandeep Sabharwal of AskSandeepSabharwal.com. Welcome to all of you and great to have you on the show. Pranav, let me start with you because it's some of your data that I quoted in my opening remarks. So give us a little bit of detail on this. When you say that the participation of retail investors in stocks listed in NSE are at an all-time high, you mean in absolute numbers as well as in a percentage of holdings, right?
Yes. So when we put out that data, that's as a percentage, the constitution of retail investors as a percentage of the overall market cap. So we look at, promoters, which are obviously the largest shareholders, followed by FPIs, and then come your DIIs, which contain your domestic mutual funds and insurance companies, followed by retail and HNIs. So as our study showed that, if you look at retail and HNI put together, that, percent is now closer to 10% of the overall market, which is at an historic high.
Right. So just to follow up there, Pranav, what are you finding? Why do you think retail investors are coming in droves and sticking around?
Well, like I've mentioned in the study, it's a combination of two factors. One is that, the way you've seen the secondary markets rallying since March 2020, you've seen a whole new bunch of retail investors coming into the market. You're also seeing that in terms of the number of new demat accounts which are opening. And then talking about IPOs, right? I mean, if you look at the number of retail applications which IPOs have been attracting since 2020, it's surpassed previous year's figures by a huge mile. Just to take an example, in 2019, you had an average number of retail applications at 4.05 lakh per IPO. That number stands at 15.28 lakh in 2021. In fact, if you look at the last 6 IPOs, all of them have seen more than 20 lakh retail applications. In fact, the last 2 have seen more than 30 lakh applications. So, you are seeing a lot of listing gains. In fact, we also looked at, the average listing gains of all IPOs of 2021 and 2020. And that figure is at 33% for this year and was at 44% in 2020. So, of course, the lure of making a quick buck on listing is attracting a lot of retail investors. At the same time, there is a dearth of other investing options. As we know, interest rates have been going down. Fixed deposit, which was typically, a refuge of retail investors in India, you don't earn too much there. So that has helped towards this. And of course, the fact that we're coming off a pandemic year, people have been working from home, having more disposable time. You've seen a whole new category of investors emerging from that, who are now using a lot of new age technology apps, a lot of new age brokers to open their demat accounts for the first time and looking at IPOs as an investment class.
So yeah, all of these points are true, but they're not necessarily new. Hemang, is it retail money chasing IPOs, or IPOs now coming in droves looking at the number of retail investors and the size of liquidity, the amount of liquidity in the markets as well? Which is it? And do you think that something has changed and stuck? Because the lousy FD returns is a story of some time now. The work from home janta and the perhaps out of work janta dabbling in equity to shore up incomes is also, I would say, a June, July 2020 story. But the fact is that these people have stuck around and their legions have grown. Why do you think that is happening?
Yeah, thank you, Tamanna, for the opportunity. I think there are 2 or 3 things. One is that, of course, that this entire last 15 months have been extremely good for the secondary market, and the way the entire IPO market has evolved in terms of the kind of IPOs which are hitting the market, be the kind of overall returns that we have seen this year as well as last year, and the fact that the post listing also. So when we look at the IPO performances, there are 2 aspects to it. One is that at what price the IPO is launched and what kind of listing gains one is really looking at, and the second aspect is post listing, what kind of performances are we seeing in the market. So I think looking at both these data points, what is coming out very clearly is that the performance of some of the IPOs have been exceptionally astounding. And typically we have seen that successful IPOs are the biggest catalyst for retail investors. And the fact that already we were adding about, let's say, about 14 to 15 lakhs accounts a month because of the successful IPOs and the kind of excitement which is around us, that number has gone up to almost 23 to 25 lakhs accounts per month. And that is helping the entire ecosystem involving the brokerage firms, the mutual funds, bank, depositories, NBFCs who are funding these IPOs, and exchanges. So I think, it's a combination of some sort of a virtuous cycle around some successful IPOs, lack of opportunities, and the fact that compared to the existing listed firms, the IPO performances are way better. If you look at any sector, particularly IT, specialty chemical, the depositories, some of these performances are way better than the existing listed firms. So I think that is driving the retail investors into the market.
Yeah, Ajay, who are these people? Who are these new breed of retail investors? Because you look at macroeconomic data and the indicators coming in, then you hear that consumption, patterns are going down, demand is dropping, except for in very small segments. But the demand for equity and the appetite for equity is in a completely different trajectory. We have some data city-wise, and Mumbai and Maharashtra seems to top it, followed by Gujarat, which is no surprise. But who are these new breed of retail investors? Are they people who have come back to the markets, or are these millennials and Gen Z who now want to make some more money on the side and just find it easier to do that?
I think, Tamanna, a lot of the answers have been given, but the short answer is it's the young people who are getting digital access at very low cost. And it is pure greed. This is profitless prosperity that is coming from IPOs. Sandeep has been tweeting about it every day. Negative net worth companies are coming to the market and getting oversubscribed. Loss-making companies. These should actually be in the institutional accredited investor space, not in the retail investor space. So it is more, and the platforms are enabling this. Plus, as Pranav and Hemang already mentioned, there is the liquidity. There's 10 lakh crores of excess bank liquidity, 6 lakh crores of reverse repo, and you multiply that and you think of the amount that is there in the mass affluent and affluent classes accounts. So the money is there, the access is there, and the greed is there. It's a potent combination. Still, it's just 4% of the population, as against a 55% in the US, because what Ronald Reagan did in 1980 with their 401 case. We have just started the NPS, and it's a very rickety kind of a structure. It will take time. You look at the Australians, which did superannuation in the 90s. they have 55% stock market participation. Japanese 44%, Chinese 13%. So a lot of way to go for us. It's still very early days, but this is becoming a classic boom bust. What happened in 92, what happened in 2000, 2007, you had 100 IPOs, just what Pranav was saying, there are so many lined up. And, it's really, I was thinking we used to do shows with his father, and today we are doing shows with Pranav. So proud moment. 100 IPOs in 2007, Tamanna, only 23 made positive returns in the next 13 years till now, and only 11 have beaten the CNX 500. Only 11 companies. There were companies like Page and Kaveri who made multi-bagger returns. 31 do no longer exist, are not listed. Nearly about 17 are in the ASM category. So they are on trade to trade, or they are operated kind of companies. So this is what's going to happen to this money. It doesn't take very too much of a brilliance. Please sear that into your mind. This time is not going to be different. It's going to be the same. The retail guys will be parted from their money. The institutional players have passed on their money. You look at, just tally up. I was in one conference call today with a very big IPO that's coming in at about a $4 billion market cap. Total PE money that has gone into that company till date is $90 million. Every 3 months, you double the valuation. What happened with the food delivery platform also, February, you do a valuation, which is again a circular valuation between the strategic investors at half the price. And then you bring in at 2x, and then on listing, it goes to 4x. So this is going to end badly for the retail investors. That much I can guarantee you. Might not happen for a year, 2 years, but somewhere it will go. And then we'll see what happens. 2007 is a stark warning. That should be pasted on every brokerage's opening page.
Oh, there's a big warning there, but a lot of things you said, Mr. Bagga. One of them is, yes, complete ode to Prithvi Haldia. I mean, he started tracking and set the base for a lot of great data that we have today. Pranav, I'm sure you must be proud. I must go to Sandeep. Sandeep, are you in that same camp as Ajay Bagga right now, who are saying that retail investors are coming in, but it's inevitable that they get burnt? Do you believe that as well?
Yeah, so I would think that Ajay has done very deep analysis of the entire IPO market and how historically markets have developed over the years. So my small point is that see, the valuations at which these IPOs are coming is crazy. You have similar, better quality listed companies available much cheaper. There's some finance company coming now at 6 to 7 times book value. Established large institutions are available at 1 to 2 times book value. Then there's this car trade finance IPO. I don't know whether that company will sustainably ever make money. So I think what's happening is that these IPO investors are actually not investors. They are in for the fast buck. So there's nothing wrong in that. So what I would suggest actually investors, the IPO investors, I won't call them investors, is that when you're doing IPO investing to make listing gains, stick to that strategy. Then once you have made your money, you get out. Otherwise, most of these companies, their valuations are so, like I would use the word obnoxious. It's unsustainable. What happens in a bull phase is that initial few IPOs are well priced, then it becomes higher and higher. And what Ajay talked of about rotational value accretion by private equity and venture capital companies, that's very real. So I would say that people should be careful what they are putting their money into IPOs for. And once you make that money, you get out. Don't make it a long-term investment. Make long-term investment out of companies which have been listed for a long time, have established records, and where you know what they do.
Hemang, I really want you to come in on some of the points that Ajay and Sandeep has made. For long, and let me just contextualize my question a bit. For long, the retail/small investor has been treated sometimes like a bit of a dull child who doesn't really know what he or she is doing, sees some money coming along and jumps in. Is it the same story today with the explosion of information now available, with the ease and access to information, to trades, to technology now available? Do you see the same red warning sign?
So Tamanna, 2-3 points I would like to make here. One is that it is not fair to say that this entire IPO bandwagon only retail investors are participating. If you see the entire breakup, there is enough participation by institutional investors, and if you see the anchor book, there is amazing participation and the oversubscription, and compared to what institutional investors want, the actual allotment that they are getting is hardly, let's say, 3, 4, 5, 10%, depending upon the size of the issue. So it is both the retail as well as institutional investors who want a pie of some of these companies. Secondly, a part of this is also coming through HNI investors who avail big amount of funding through NBFCs. And there is a strategy wherein you raise funds at X percentage, depending upon your expectation of oversubscription, you put in that money, you get the allotment and you exit on the listing day or immediately after that. And there is an X amount of flip money, as we call it, it is being made. That's a different ball game altogether. Thirdly, we can all debate here that, all these companies which are hitting have X valuations and, you cannot sustain this. But we have to remember that in a bull market, you will have certain number of companies which will give you that big multi-bagger opportunity also. And if you see last 1 year, even historically, yes, some companies do go bust or there is some negative return, etc. But in a bull market, if certain investors are allocating X percentage of their capital into some companies where they see a bigger opportunity, I don't think it's wrong way to look at it. So I think this entire thing about valuations, etc. Yes, because we have all seen a certain legacy issues and the past performances, we are all a little influenced by that. But you may come across certain emerging opportunities where we are not comfortable, but those companies may go on to become multi-bagger companies over a period of time. So I think we should look at this whole thing in a slightly balanced manner.
Oh no, so let me ask the question very directly, Hemang. Ajay Bagga a short while ago said that it is clear that retail investors and their money is going to be parted. He sees this ending badly for a large number of new entrants to the market. Do you agree with that view?
I think that if you are going to look at, let's say, X number of companies, okay, we have to see out of, let's say, 10 companies which are coming into the IPO market, maybe 30-40% companies may not deliver the returns as per expectations. But if this entire economic cycle turns very strong over the next, let's say, 2, 3, 4 years, you may find some emerging companies which will give you 5x, 10x, 15x returns also. So depending upon what kind of allocation you have made to those companies, you may be able to make that extra return on your portfolio. So I definitely think that it's not right to say that everything is going to end badly, investors are going to lose money, etc. I think we are in a market which has become far more dynamic. Valuations is always a relative terminology. 1 year back when we had this COVID, people had all doubts about valuations and whether there is going to be earnings growth. Today, people are talking about what kind of sustainable earnings growth are we really looking at over the next 2 to 3 years. Look at what is happening to global markets. So just by looking at valuations, if you are going to make a generic statement that, this is going to end very badly is not right. I think it all depends upon the kind of companies and what kind of bull market cycle are we going to see ahead.
Pranav, you want to come in on this debate? It's getting quite interesting. How do you see this moving ahead? Simply put, and let's not just attach retail investors to IPOs. IPOs, of course, are sort of the cherry on top of the cake, but the fact is that retail investors are coming in larger numbers and sticking around beyond IPOs as well. Do you think there is enough to sustain these kind of numbers?
Well, so I have a couple of points to make first. To Ajay's point, the 2007 study, which he quoted of 100 IPOs, that's true. In 2010, again, you had 64 IPOs and only 17 of them are in the positive territory. But if you look at some of the recent years, 2017, 36 IPOs, 23 are in positive territory. 2018, 24 IPOs, 13 are positive. 2020, all 15 IPOs are in positive territory. So I think one important fact that we need to keep in mind is that the quality of companies that you are now seeing coming to the market are much, much better than what you saw in the mid 2000s or early part of last decade. The regulations have become much tighter. These are much more mature companies. There was also a point about private equity and venture capital being invested in these companies. And, you are seeing a lot of such funded companies coming to the market. And yes, while there might be concerns around valuation, but at least it gives confidence to retail investors that a certain amount of due diligence has been done on these companies. Certain good corporate governance practices would be established in such companies. Another point about private equity and venture capital, of course, is that, over the years, we've also seen the nature of our market changing significantly. From 100% of the overall IPO amount being raised as fresh capital, now you're seeing only about 15 to 20% of IPO amount being raised as fresh capital. And 85% is actually, exits by investors and by promoters. I think one very important metric which needs to be looked at is that are such investors exiting completely at the time of IPO, or are they holding back some stake as well? If they are exiting completely, then yes, a certain alarm bell should go up. But in case you do find these investors are holding on, then it shows that they have the confidence in terms of future prospects of the company as well.
Ajay, any points you want to respond to from what Hemang and Pranav have said?
No, 2020 numbers don't count at all, because if even on March 24th, whatever you had has doubled today. So, that kind of a cycle you can't compare. I'm comparing a 12, 13-year cycle, which has seen a lot of money coming in 2008. That's why I'm giving a 13, 14-year number, which came out. So I don't agree. If somebody is selling IPOs, obviously he will say this is good. But, when all the aunties and all the Mofassil, housewives are out to try and learn F&O and make a quick buck, alarm bells are starting. It will not end right now. Howard Marks said that it takes 3-4 years. In 97, I remember, he had started talking about the .com. Warren Buffett lost a lot of money. Now you have newfangled analysts who come and insult Warren Buffett every day on channels. He made losses in 99, but we know what happened in 2000. At that time, you were adding .coms. Now it is a delta strategy where you just add digital to any company. You have companies, what Pranav said is totally circular logic. People are not taking growth capital. They are doing OFSs in IPOs. They're selling 40% of their stake out right now. So the promoter is cashing out. I remember, there was a time when Citibank was looking at buying a mortgage business from GE. And John Reed had said, why will I buy anything that Jack Welch is selling? Promoter is selling 40% of his holdings in the IPO and taking out the money. It's not going to the company. And you want to invest in that IPO. And there's no regulator protecting you. We have removed a profit, a profit conditionality. We have removed a positive net worth conditionality. You would expect that the regulator and the retail investors will deserve what they get. This is gamification of investment that has happened. These are very smart investors. They are making a lot of money on cryptocurrency. They are contributing 45% of volumes to the trading. So they are very valuable customers to the brokerages. Why will they call them dumb money? I have no brokerage or I have no service to sell. So I can call it for what it is.
But Mr. Bagga, on a separate note, what is wrong? No, absolutely. What is wrong with aunties in Mufassal towns learning about FNO and wanting to make money? Why is wanting to make money suddenly a bad thing?
Yeah, so it is purely greed. It is like in 2008, people were, the liftmen really in Chandamukhi building were saying, Reliance Power, it is like DLF coming at a very high net asset value, which, good compliant people gave to them, and that IPO price never came. How many numbers and how many names do you want to know, Tamanna? How can you expect these people? They should be starting with index funds. They should be going to mutual funds. LC Gupta did a study in 92, 93 that the customer who comes into, and at Harshad Mehta time, 11% Indians used to invest in equities. I'm old enough to remember those studies. Those studies are no longer done. What is the standard practice in India? You come straight from fixed deposits to pure equity. Now it is into F&O because of gamification and because of zero brokerage, easy access. All you need is a phone and somebody is giving you tips. You crash and burn and you never touch equities again. That's why you are at 4%. The traditional model is let an institutional player manage this money who's highly regulated, who manages for the retail. The traditional model is not letting the retail investor come in directly because they will be butchered. That is all I'm saying. But maybe it has changed. Maybe I am outdated. Maybe the people are very smart these days with all the facilities that brokerages are giving them, all the analysis. Maybe it will turn well. Good luck to them. But history doesn't show that. And every time, Tamanna, in 2000 it happened. Julian Robertson returned his money in March 2000 at the peak. And why did he return? He was sitting in the US cab, and at every red light, the cabbie was doing day trading. That day he returned the money. He says, guys, I cannot invest what Sandeep is saying at 100, 150, 300 times our IT companies were trading at. They never reached those levels. Even now, after 20 years, we didn't reach those PE levels. Now, if it's a 450 PE consumer company, you would go to Hindustan Levers and Nestle.
Fair point. But now, a very important question. Yeah, very important point that Ajay Bagga has raised, and I want Sandeep Sabharwal's view on it, before we close the debate. Sandeep, the point about regulation. Do now this fresh crop of small investors need protection? We've seen the BSE circular. It caused some, havoc in small and mid caps, and there was a clarification today, and then some nerves were calmed. Do you think there is a case for more scrutiny, for more fencing, for more guidelines to make sure that people don't, as Ajay Bagga says, crash and burn?
Yes, I think the due diligence process and what kind of companies can come to IPO and be sold to retail investors, that's been diluted significantly. Now, what thought process has gone towards that is I'm unsure of. Maybe it's just to make sure that all kind of new generation companies get the capital they want from the public markets. So the thought process might be right, but what it's leading to is that it's leading to companies coming at valuation. So see, the debate, Tamanna, is not about IPOs. I'm not against IPOs or anything. I am just talking about valuation. So if you buy a company at a PE of 100 times, irrespective of how much rate at which it grows over the next few years, it's very tough to make money out of that. So that's the point that should be debated, and that is not getting debated because every IPO is getting oversubscribed so much and then getting a listing pop. But it's not necessary that this listing pop will last. So regulatory, whether there should be regulatory protection in terms of should there have been positive net worth, should the company that profit track record theme also has gone out. But did those things protect investors in the past? Because as Ajay said that a lot of IPOs which came with those kind of protections also did not make money. So I think it's all a question of proper due diligence. It's just a casino. This IPO market is a casino largely, yes, there will be some companies which will become multi-baggers out of this over the long run, not now. So like I said, early part of bull market, IPOs make money. As the bull market matures, the valuations become so obnoxious that it's tough to make money. I would bet that 2 years later, 90% of the IPOs which are coming now will be trading at prices which are below their listing price.
Well, we'll have to wait and see. You're here, we're here. We'll have to wait and see whether the party ends and how the party will end. But expecting people to stand outside and wonder what to do when there's a party raging on may be difficult. And it's clear that more and more Indians want to jump on to this bandwagon. Thank you so much for this very interesting debate to all of you. We'll take a very short break on the India development debate. On the other side, we're talking about the washout